Every major economy on Earth has a central bank, and their job basically boils down to one simple rule: deciding how expensive it is to borrow money. That single decision affects everything in your day-to-day life, from your rent, your mortgage, your credit card balance, even whether your boss keeps hiring or starts laying people off. This is about interest rates, okay? How they work, why they matter, and more importantly, what you need to know to stop being on the losing side. Welcome to Alux. Today we're talking about the price of money. So imagine you're buying a house, and like most people, you're borrowing money to do it. To keep it simple, let's say you take out a 10-year loan. The house costs $300,000, and after 10 years, assuming steady appreciation, it's worth about $400,000. At low interest, say 3%. That $300,000 you borrowed ended up costing you around $350,000 after a decade of monthly payments. That's still less than what the house is worth, so you come out ahead. You build equity. But when rates climb to 6%, the story starts to change. Now the cost of borrowing rises so much that after 10 years, you're barely breaking even. The value of the home and what you've paid to own it are almost the same. Push rates even higher, and you cross the line. You're now paying more for that house than it's actually worth, and since that's a bad deal, the demand isn't that high, so the price of the house actually drops. At that point, the math is working against you. You're losing money simply because the price of borrowing is too high. You swap that house with a car, a credit line, a business loan, a hospital bill, even the national debt of an entire country, and the same logic applies. The higher the interest rate, the more wealth gets drained away. Which, it raises a natural follow-up question. If low interest rates make everything more affordable, why not keep them near zero? Wouldn't that make everyone richer? Well, here's the problem with that. When interest rates are low, money feels cheap. Borrowing is easy, mortgages are affordable, and companies can finance growth almost for free. And at first, it makes everything look like a bargain. But that cheap money fuels demands, and soon prices begin to climb, faster and faster until you're no longer buying a deal, you're buying into a bubble. Then comes the flip. Central banks step in, raise the interest rates, and suddenly the price of borrowing shoots up, which makes demand fall away, and with it, the price. Now, here's the thing though. It takes anywhere from 5 to 10 years for prices to keep climbing, but the bubble pops in as little as 1 to 2 years, and the aftermath drags out for much longer. It can take another 5 or 10 years for the market to recover. Now, when you look at this graph, one thing becomes apparent. The optimal buy window in this cycle is actually pretty small. The first stretch of the upswing is where billions are being made, and we'll explain how that happens a little bit later. But if you miss that, you're left with the worst of both worlds: expensive assets at the top of the cycle, or falling prices that are impossible to finance because credit is too costly. Now, what we do know is that the cycle always repeats, and we don't know how high each boom will take us or how far that crash will drag things down. The only thing history guarantees is that, over the long run, that trend is always upward. But to effectively spot trends, you need to be well informed and recognize the kinds of factors that will have the greatest impact on various industries. And inside the Alux app, we help you gather all the knowledge you need to cut through the noise and decipher the data that actually matters. We hire industry experts, pay them their steep consulting fees so you don't have to, and grant you access to hundreds of hours of high-value lessons for less than $200 a year. Even better, if you download the app now and scan the QR code on screen, you'll get 25% off the annual membership. I'll see you on the inside, but in the meantime, let's get back to the topic at hand, shall we? So, when it comes to interest rates, who's actually pulling all the strings here? We already said it, right? Every major economy on Earth has some form of central bank. The Federal Reserve in the US, the European Central Bank in Europe, the Bank of Japan, the Bank of England, and so on. Their job is simple in theory, but massive in impact. They decide the base interest rate. That's the anchor that sets the price of all borrowing: mortgages, credit cards, car loans, business debt, even government bonds. And because the US dollar is the global reserve currency, every move the Fed makes doesn't just affect Americans. No, it ripples across the entire planet. Money flows into the US when rates are high and flows out, chasing risk when rates are low. That's why a 0.25% move in Washington can shake stock markets in Tokyo or collapse currencies in Argentina. And me, you, we all saw this play out in real time over the last couple of years. In 2020, when the pandemic shut everything down, the Fed slashed interest rates close to zero. US mortgage rates dropped to around 3%, the lowest in history. Suddenly, everyone could afford more houses. Buyers rushed in, investors piled into real estate, and prices skyrocketed. But by 2022, inflation was running hot. Gas, food, rent, everything was climbing. So the Fed flipped the switch. Rates climbed aggressively. By 2023, mortgage rates had shot past 7%, more than double what they had been just 2 years before. Almost overnight, housing affordability collapsed. Buyers couldn't qualify, sellers pulled their listings, and the market froze. The houses themselves didn't change. What did change was the price of money. So, who really wins when money is cheap? When interest rates are low, most people only notice the obvious. Mortgages get cheaper, car loans are easier to qualify for, maybe you can stretch your budget a little bit further. But for the wealthy and for corporations, low interest rates are something else entirely. They are a weapon, and they know exactly how to use it. The first way is through corporations issuing low-yield bonds. Now, before we go any further, let's just clear up a common confusion here. The difference between a stock and a bond. A stock is when you buy a part of the company. If the company grows, the stock price grows and you can sell it for a profit. Simple. But a bond is when you lend money to a company. You are buying said bond. You give the company that lended money, they are legally obligated to pay you back with interest. Lower return, but it is safer. And here's the key, okay? Only governments, corporations, and big financial institutions can issue bonds. You and I can't do that. Government bonds are considered the safest asset in the world. If you buy U.S. Treasuries, which is the official name for the bonds issued by the U.S. government, it's not like the U.S. will go bankrupt. It can literally print dollars to pay you back. And because they're so safe, banks, insurance companies, and pension funds are legally required to hold a portion of their reserves in them. If you start a bank tomorrow, regulators will force you to park some of your cash in bonds. Not stocks, not bitcoins, bonds. And this matters because when interest rates fall, the yields on government bonds fall with them. In 2020, U.S. Treasuries yielded around 0.5% to 1%, the lowest in history, which meant if you lent money to the U.S. government, you were locking in a return of basically nothing. Now, here's where corporations like Apple and Amazon step in. They can also issue bonds, and all they have to do is offer a yield ever so slightly above treasuries. If government bonds are paying 1%, Apple can say, well, we'll pay 1.2%. And since Apple is one of the safest companies on earth, institutions will happily buy in. Just think about the position of a pension fund. They're sitting on billions. By law, they must buy bonds. Their choice is between a U.S. Treasury at 1% or an Apple bond at 1.2%. The risk is almost identical, but the return is better, so they pour money into Apple. That is how, during the low interest rates of the pandemic, Apple raised about $14 billion and Amazon about $10 billion at yields as low as 0.4% to 2.5%. For comparison, that is cheaper than the average American car loan. And they didn't need the cash. Both companies were already sitting on mountains of it. But when money is that cheap, it makes sense to borrow instead of spending your own. They used it to expand warehouses, buy competitors, invest in infrastructure, and solidify their dominance. That is how they get so big. It's not the new iPhone camera that made Apple a $3 trillion company. Now, switching gears slightly here, wealthy people play the same game, just on a personal scale. And if you watched the Buy, Borrow, Die video, you know where this is going, right? When interest rates are low, the rich don't cash out assets to fund their lifestyle. They don't sell stocks or properties and trigger massive tax bills. No. Instead, they use those assets as collateral and borrow against them. So imagine you own $100 million in stocks or real estate. At 2% interest, you can walk into a private bank and borrow $20 million against that portfolio. You pay almost nothing to access that money, and because it's a loan, not income, you owe zero in taxes. That borrowed cash can fund your lifestyle, buy more assets, or be reinvested to generate even higher returns. This is the strategy known as buy, borrow, die. The wealthy buy assets, borrow against them to live tax-free, and then, when they die, pass the assets on to their heirs, often with tax advantages that wipe the slate clean. You can check out the full video in the description. All right, now, cheap money makes this strategy insanely powerful. If you can borrow at 2% and reinvest into assets growing at 8 to 10%, you're compounding wealth almost for free. And unlike a normal family using credit cards at 20% APR, billionaires borrow on the cheapest terms imaginable. So, just like corporations issuing low-yield bonds, rich individuals weaponize cheap debt to get bigger, richer, and more untouchable. And they just ride that wave until the next cycle comes along. So, what does this have to do with you? Well, my friend, like it or not, interest rates control your life. You can ignore the stock market, you can ignore crypto, but you cannot ignore interest rates. Whether you realize it or not, they shape nearly every major financial decision in your life. The home you can afford, the car you can drive, the credit card bill, even whether your boss hires or fires, all of it is downstream of interest rates. They decide if debt is manageable or if it eats you alive. At 3% interest rate, a $300K mortgage is about $1,300 a month. At 7%, it's closer to $2,000. That's the difference between building equity and being locked out. While Apple borrowed at about 2% during the pandemic, the average American credit card stayed above 16%. Student loans reset every year based on the treasuries. When interest rates are high, graduates begin their careers with heavier monthly debt costs. For small businesses, when borrowing costs rise, banks just stop lending. So equipment financing, payroll loans, even working capital dries up. So what do you do with this information? Well, you personally can't impact the global economy, nor can you predict when the next crash will happen and what market will be hit hardest. All you can do is know that when money is cheap, that is when the rich borrow for productive assets, refinance existing debt, or lock in long-term fixed rates. When money is expensive, that's when the rich avoid liabilities, sit on cash, and prepare for opportunities. We hope you learned something valuable here today, Aluxer. Thanks for spending some time with us. We'll see you back here next time. Until then, take care.